Hey everybody, my name is Roy. Good afternoon, April 6, 2016. I'm going to try to keep this one quick because I'm coming at you just about every day, and I think that may be how this week unfolds. So let's just get right into it. The chart in front of you is the dollar. That's this mountain chart, the white line. The green line is the S&P 500, and the purple line is oil. I circled there this morning when the EIA came out and gave their report, showed 4.9 million barrels draw from inventory. So inventories were declined by about 5 million barrels. That just shot oil prices higher. It shot the stock market higher immediately. The market was trading lower on those inventory reports that traded higher. Here's when the Fed meeting minutes were released. Initially, there was enough talk of some dissent among the ranks that I think got the market a little nervous. I saw it in sectors like utilities and financials and telecom. They took a little bit of a hit there. Utilities still closed today a little bit lower, but the other ones found their way into the green as the market rebounded, when I think the consensus basically viewed it as a pretty dovish commentary or minutes release, and that the Fed is going to be very reluctant to essentially do anything to this chart here, and that's the dollar. As I illustrated for you in a few charts on Saturday, a low dollar today is very bullish for asset prices, and the Fed believes it's very bullish for the economy in general, and that it needs a little more help before they potentially create some upward pressure on the dollar by raising interest rates. That's a whole other conversation that I've given you some texture on, because that doesn't always happen that way. But so anyway, when the market just came screaming back, caught up with oil. Oil closed a little lower on the day, and stocks closed really close to their highs. So it was a good day. It was a pretty good day across most sectors. Transports and utilities would be the exception, but high yield debt rallied, which means the credit spread, yield spread came down. That's bullish for stocks. Treasury sold off. Treasury yields rose. That's bullish for stocks as well. So all in all, when I look at price action, I look across sectors, it was a legitimately good rally today, and I was pretty skeptical of it until very close to the end. So here's a one-year chart on the S&P. We've come below that wedge pattern. This 2045 to 2060 was quite the range today. Let me just bring in a 30-minute chart. There we go. So this is what I was noticing today. A lot of resistance right here at 2045. I'm sorry, support, and then resistance right at 2060. And then we shot through it. That's a good sign. The reason I drew that 2060 line there is because that's right where that lower trend line, that downward sloping trend line, fell today. So I thought that'll be an interesting one to see. We closed above it, we closed below it, closed above it. I'm still going to keep these here for now. I suspect that in the next few days, we're going to find out if that's going to be support as the market stays above it, or it's going to be resistance if it comes back down and bumps its head against it. And then there's lower levels that we'll talk about. This continues to look better, the 50-day in its direction relative to the 200-day. This down here has been one of the indicators that I've illustrated for you that have concerned me of late. And let's just real quick go back to that correction back in August. Look at here when this last correction started, and look what happened in August, how the signal line told us that the market was probably going to trade lower. This upward slope amid a relatively flat line here was bullish, just like it was here, as I illustrated for you a while back. But notice what happened right about here is the MACD line began to flatten out. The market struggled at these levels, struggled again, and just couldn't come above that level, and finally gave up the ghost. And then here we had a similar pattern forming. And this is where I was telling you folks, I really think the bias has to be the downside. Well, it's hanging in there. As you can see, the signal line still says it's a downward bias. But it doesn't quite shape up like this one. I mean, it was pretty decisive right here, and it ultimately came true. This one is struggling with it. One key difference is back here we had a Fed that was very hawkish, and the market was discounting a Fed rate increase coming up, which it got. Right here, it's not the case. Right here, I honestly think that we might otherwise be looking at June. You're going to hear a lot of rhetoric, but I keep talking about this referendum in Britain. If that basically happens, or if we get close to it, and it looks like there's some risks there, I don't think the Fed's going to want to raise interest rates in that environment. So then we're talking about September. So it'll be not that the market's going to hold up just because the Fed doesn't raise interest rates, but I do think that's what explains why this signal isn't turning out to be a great signal and that the market isn't selling off in a big way. That could very well happen tomorrow. That's still my bias on a near-term basis, folks. I still like the market very, very much for our long-term portfolios. And again, as I say virtually every time, this is me helping you put the short-term in perspective so it doesn't freak you out when we get a great deal of volatility. And I do think that's coming, and I think it's coming in both directions, actually. Thank you once again for watching and listening, and I'll talk to you very soon. Bye-bye.